Bulls on the market say that falling interest rates, decent profits, and an increase in market breadth are all creating a bullish outlook for stocks. And here's a warning. Our guest says investors who wait too long for clarity could be left behind. Our guest likes tech, large caps, and high-quality balance sheets. We're joined by Ross Mayfield, investment strategist at Baird. Thanks very much indeed for joining us. I suppose, there's always a reason not to invest in the stock market, but you think there's a real risk of missing out here.
Yeah, absolutely. I mean, we see it in our business, particularly around political uncertainty. We've seen some of the ways that folks try to measure this sort of thing. The NFIB survey has an uncertainty index that hit an all-time high. Policy uncertainty is elevated, and we can just hear it in conversations. But we're in a bull market, and if you sit on the sideline and wait for that sort of clarity, you miss out on big chunks of those gains, and it gets really, really hard to get back in when stocks are making new all-time highs day after day. So, we think being invested, remaining invested through the uncertainty is the way to kind of build long-term wealth.
So are you a fan of market timing ever? Do you ever think there's circumstances warrant selling some or all of your stocks?
In our world, we try not to get too tactical. Certainly, there are reasons to sell, if you're an individual stock owner, if the thesis breaks, if you're trying to raise cash or need liquidity. In the wealth management world, we see that all the time. But primarily, we definitely don't believe in market timing around things like political events or geopolitical uncertainty. History has just borne out that works far less often than it might or than you might expect. And so we think that the risk reward is not really there to pursue that kind of strategy.
U.S. Treasury yields did move up this week, investors demanding a better return before they buy U.S. bonds. We saw the yield on 10 years go up to about 4%. What's your takeaway from that?
Higher yields are going to cause angst for equity investors. They have for most of this cycle, but really I find it bullish or at least optimistic for the economic outlook. I mean, if yields were falling through the floor right now, I would be much more worried about the market's view of the growth outlook. And instead, yields are holding firm. I mean, they're obviously reflecting what the Fed wants to do, which is cut interest rates throughout 2025. But a more normalized 10-year in the 4-ish% range, I think is pretty healthy. And the fact that it's not dropping like a rock signals that the market believes the economic growth outlook is still pretty good.
What about the economy? Well, was it Warren Buffett? I think he said, if I spend 30 seconds on the economy, I've wasted my time. Do you pay much attention to the economy, or are you more focused on corporate profits and dividends?
Well, it's interesting. It depends on the kind of investor, right? I mean, Buffett is a very concentrated portfolio, single stock investors. So looking at the balance sheets of those companies and their individual outlooks. For a lot of investors, though, who are invested in the market writ large or in funds that have large, a lot of holdings, the direction of the economy and the direction of kind of the general profitability really matters. And so that the U.S. economic outlook is at or directing towards a soft landing, that rates are coming down because inflation is low, and that the U.S. labor market is holding up is pretty big and pretty important for the overall outlook for the market, right? We're a consumer economy, so it matters what the consumer is doing, not just for our individual companies, but for the market writ large. So we do pay attention to it. It's important to our outlook, and things look pretty good right now. Not perfect, of course, but pretty good.
You do like tech. Is there particular areas of technology, or just do all the Mag 7 look pretty decent right now?
Obviously in focus today because there's some, concern that the FTC is looking to maybe get a little more aggressive on the antitrust front. But, the way that we think about investing in long-term themes is that you want to be buyers on weakness. And even if this kind of tech relative underperformance persists, we want to be exposed to those kind of secular growth themes like AI, like digitalization over the long term. And so we're fine if over the next 6 months, cyclicals continue to outperform, software, but we want to be exposed to those. And we think that pullbacks or air pockets in the AI trade is a good time to add exposure. So that takes a bit of a long-term view on it, but certainly, the AI theme, I think, has long legs.
We've seen this move or the broadening of the market, people more interested in smaller stocks, but your bias is towards larger companies?
Yeah, I think, look, I'd love to see the breadth expanding, cyclicals outperforming. Obviously those economically sensitive stocks outperforming is reflective of what we just talked about, which is a solid US economy. But the backdrop for small to outperform large over a decent period of time, I just don't think it's there. You still have, even as rates are coming down, as we mentioned, looking a lot higher than they were at any point over the last decade, really, or at least the decade prior to COVID. So you still have a high interest rate environment. Labor and inflation are both much bigger problems for small business than they are for large cap. And then in places like tech where or AI, I should say, where huge investment is required to kind of reap the gains down the road, the productivity gains. Smaller businesses are at a disadvantage. They can't make those huge upfront investments that the Mag 7 are making right now, and so it leaves them playing catch up a bit. I still favor large cap and some of the more moatier oligopolies over leaning into the small rally.
Somebody should launch an ETF that just invests in oligopolies. Thank you very much indeed. It's great hearing from you, Ross. Ross Mayfield.